let's just talk about who owns this inventory. How big is this inventory, right? Like what is it? What does it look like? So there's a lot of data sources. Pretty much they all are in compliance that over 70% of all rent houses, 1 to 4 family, are owned by hobbyist landlords. They dominate the market. People think, like, you read these articles every week, it's, build to rent and blah, 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 and the hedge funds and stuff. And yeah, they own a good many properties, but they don't own 17 million.
That's still mom and pop that run that market.
72% of the market is dominated by mom and pop. And so when you really start cracking that code, who is that guy? Who is a hobbyist landlord? There's a debate. Most experts call it they own 1 to 5 units. Some people say it's 1 to 10, and that's a little more, that opens the window a little wider, but they're not the people that you and I know that own rentals.
Yeah, it's usually a couple, 2 or 3. A lot of these guys I know have 2 or 3 different rentals.
So the whole sexy thing happened. The HGTV, they got all fired up. We're going to go do this. They were trying to get some independence from the stock market, which is, listen, people that are my age that had all their money tied up in the stock market and have lost half of their net worth a couple of times in these dramatic markets.
Drops. Yeah.
They start looking for alternatives. It doesn't mean they don't have any stocks, but that's what forced people really after 2010, 2008, then it forced people to start looking at alternatives. That's what drove the apartment business so crazy.
Yeah, big time.
All of that was like people looking to be in the business and have independence from just being their net worth being tied to stocks and bonds. Here's what happened to the investor. You and I have a mutual friend. He says it this way: they were promoted a piece of real estate, right? That's a little different than saying they were sold a piece of real estate. So somebody on the internet, or somebody that was selling rentals, or some specialist realtor that did this, or maybe, they went out there and they got this Excel spreadsheet template, right? They're all smart, they're educated, and they have this template, and they plug in the rent, and they plug in the expenses, and they run all this modeling, and it tells them their yield, their cap rate, and all this stuff.
Yeah, but they're going to cash flow.
They were all kind of like bought that, and that's what sold them the property. What they thought is something happened to Excel because it broke. Because their Excel spreadsheet does not match their checking account.
That's right.
So that's why they don't like the rental, right? Yeah. And here's what's amazing to me. Statistics say that about 3/4 of these small-time landlords today still self-manage. So they haven't gotten some management company to do it for them. They're still trying to, honey, I can do this. Yeah. And that's why that's their rent property pain. Here's what's weird. They've owned a rent property for 5, let's just define a customer, right? They've owned a rent property for 5 years, right? The real estate market has been insanely good to them, right? The tenant and the rent house, one or both, has been insanely bad to them.
Yeah.
Right. So here's what we figured out. No matter how sophisticated the person is in other areas of their life, and a lot of times they really are. They're a corporate executive, or they're an entrepreneur, or they're smart people.
Yep.
But they're not specialized. You and I are specialized, right? Yes. You and I instantly know that if you can go sell your rental and owner finance it, you can pay your taxes over the next 20 years. You and I intuitively know that. I mean, we know that as much as how to go crank our car.
Yeah.
That's not, the general public doesn't know that. So we started marketing for people that own rentals, showing our students how to do this, but marketing to people that were the opposite of what most people were list stacking for. They were list stacking for a landlord that had a divorce, that had had a judgment against him, that had all these kind of strikes against him, and that showed him he had a financial motivation. What they discovered is the guy that sat in front of them that didn't want the money, the real core behind him not wanting the money, he was dying to get rid of the rental. The core behind it was, particularly in a new administration, call it whatever you want to, they were worried about taxes.
Yes.
And if you could suggest to them, well, you wouldn't have to pay the taxes today, you could defer your taxes over the next 20 years, they'd lean up and go, what? What did you say? So here's the thing. I changed how I used to teach this. I used to teach this kind of like this, Paul. I would say, I'll give you your price, Paul, if you'll give me the terms I need.
Terms.
Right? I don't say that anymore. I say, Paul, I'll give you your price and I'll show you how we can defer your taxes over a long period of time. Right? So it becomes the IRS strategy that seller financing is involved to make that happen, versus saying you have to carry terms. No, Paul, you get to carry terms.
Yeah. You just bring it in a different way.
Yeah.
And really that's what they need to see, because if you go the first direction you were saying, totally, a lot of people just shut down because of what you just went to with the taxation. If you're showing them how they can defer their taxes, because look, nobody wants to deal with that big tax bill coming up, especially with Joe Biden trying to run up the rates to 40% on taxes. So that's going to be so key the next few years in this market. And I think you're going to be able to get so many sellers, especially with the appreciation that they've had in this market. So it is there. It is wide open.
Most of the small time landlords took straight line depreciation. A lot of them didn't take the other accelerated versions.
Right. Yes.
Right. So they can, I'm not giving tax advice here. Okay. So I want to be clear about this. They can defer long-term depreciation like they can defer capital gains. It can be amortized over a long period of time.
Right.
Accelerated depreciation has to be gained in the year they sold it.
Yeah.
Now we've developed a financial modeling way to show them how to accomplish that. Then once you get to this piece in the conversation, you still haven't gotten completely the psychology yet. What you've done is you've given them a chance to lean in to like, well, hold on a minute. Tell me more about that. You give them a chance to lean in, and then it becomes, now let's talk about your pain and what a perfect world would look like.
Yeah.
There's no 100% of anything. There's no 100% customer base that every customer thinks the same. Every customer has the same problems, but there definitely are patterns. The pattern seems to be this. By the way, 50% of this demographic, this 17 million houses, 50% of them don't have a mortgage.
Yeah, that's the really interesting part.
What were they buying? That tells you what was triggering the investment when they bought it. They weren't trying to go do some highly leveraged deal like some real estate cowboy like you and I know, right?
Yeah.
What they're trying to do is just deploy money and earn income that was passive. But see, they didn't experience passive income. If they owner financed, however, they really, truly could get passive income.
Yes. Without all those other headaches.
Yeah. Now that's not the leading conversation. It's the closing, but it's not the stop and look question, right? You have the stop and look question is did you know that you could sell your rental property today, but yet defer taxes over 5 to 20 years?
Yes.
And that conversation then gets the audience to sit down in front of you. So that's the idea. I go back to what I said. Every real estate entrepreneur has to find the niche in the market that's not solved.
Yeah. Find that void. and you'll be uber successful. You have much less competition filling that void too, and much easier sales. Really, it's a lot easier than dealing with what you think about your average Joe flipper out there right now, right? I remember, and you remember back when their average acquisition cost for a deal was around 1,000 or 1,500, 2,000 tops. Now most of them are sitting close to $5,000 per deal, cost per deal, because of how many more contracts they have to offer just to get one and how much a marketing costs. So this, you could do far, far less expensive. You could really maximize your return on your list for sure and get a lot more yeses.